Welcome to another episode of Did You Know? Today, Mike Harvey is going to be answering some questions about taxes and preparing for taxes.
Oh, man. Whew. Hi, I'm Michael Harvey. I am the head of the tax department. Right now, I'm abandoned on this barren planet of Tatooine to get ready for tax season. I am just navigating the imperial forces known as Reef Holdings to get to my Garden of Eden, which is really April 15th, which is when the bulk of tax season is over, so that I can get in my Millennium Falcon and take off. But until then, I'm just mired in all the questions and difficulties of tax season here on Tatooine, and my lightsaber is not fully charged to fight the battles that I need to fight. So wish me luck, and may the Force be with you.
What documents are needed and how could they best be organized?
The documents that are needed by the tax preparer generally are going to be things that show income or deductions. So things like your W-2, a 1099, maybe a statement from investment or an investment company like Merrill Lynch or Charles Schwab. Those are the main documents that your preparer needs. But if you have a Schedule C, if you have a company that's reported on a Schedule C or a rental property, they're going to need some kind of general ledger report, such as a balance sheet and a P&L and a general ledger from that activity. And the best way to organize your documents is you can ask your tax preparer for an organizer, and it prints out your prior year information in the organizer, and it tells you what documents you should need for the current tax year to send to the tax preparer, and you can organize them with that organizer to send to your preparer.
Am I eligible for any tax credits or deductions I might be missing?
A tax credit or a tax deduction is really, there's not a blanket answer for that. Everybody has their own individual tax situation. So one person may be eligible for something and another person may not. That would be something to discuss with your tax preparer as they are aware of your tax situation. And if you prepare your own taxes, you can consult with the tax preparer to see if there are things you may be missing.
How can I adjust my W-4 to avoid owing or getting too large a refund next year?
When you fill out a W-4, you should fill it out for the number of dependents you're going to report on your tax return. So if you're married filing joint, you want to fill your W-4 out for two people. If you have two kids and you're married, then you want to fill your W-4 out for 4 people. You want to report on your W-4 essentially how many people are in the household to keep your tax as even as possible to avoid owing a lot or getting a large refund.
What changes in tax law this year affect me?
On the individual side, there's not a lot of large changes. It's just that the changes that have been implemented before are still ongoing. The biggest thing for individuals is that the standard deduction is quite large. I believe this year it's $24,700, which means you would have to have itemized deductions above that total in order to itemize. For most people in the middle tax bracket, the standard deduction is probably going to cover you. But if you are in an upper tax bracket and you own large houses and have large mortgage interest payments, or you make a large charitable deduction, then you're going to go over the standard deduction, and that's when you're going to have to track your itemized deductions for your tax reporting.
Are there steps I can take now to lower next year's taxes?
If your income is static for 2025 as it was in 2024, your tax liability at the end of the year is going to be very similar to the year before. Taxes are based on income, so if your income goes up, then you need to be aware that your tax liability is going to go up as well, unless you have additional withholdings on your income or you make other large charitable contributions, or really those are the two basic strategies to try to reduce your tax bill when you have a large increase in income.
Should I track any deductible expenses during the year, even if I don't itemize?
Tracking deductions is more related to if you have a Schedule C business on your return. As far as an individual without a Schedule C, there's no need really to track very much. If you do have a Schedule C, then you want to have your own set of books for that business to track your deductions. In addition to that, in particular, you want to track your mileage to get the auto deduction on your Schedule C as well.
Is there anything about my lifestyle, moving, education, dependents, side work, that changes my tax picture?
Those areas really do not have a large impact on tax. Of course, with kids, you get the child tax credit. But outside of that, again, with the large standard deduction, that really doesn't have a large impact on lowering your tax bill.
The following questions are for employees who might be small business owners or have side businesses in addition to working for Reef. What business expenses can I legally deduct, and how should I track them?
As far as business expenses are concerned, you can deduct anything that's related to the business. So if you're a real estate professional and you're running a Schedule C on your 1040, then you can deduct mileage. You can deduct anything you pay to capture clients, such as advertising or taking a potential client out to dinner, or anything related to the business itself. Also too, if you're running your business through a home office, there is a calculation that's easily found on the internet where you can take part of your household expenses, your utilities, your mortgage, your property taxes, and run that through the business as well. And actually running anything house related, including property taxes, is more beneficial to run it through a business than on a Schedule A, because on a Schedule A, it can be, your tax liability, your property tax payment can be reduced, as well as your mortgage interest payments, where if you have a business, the whole amount you report on your business will be deducted.
What's the best business structure for me for tax purposes?
If you're running a single member business, the best structure is to be an LLC. If you run a business as a S corporation, you are required to have a payroll, which increases your tax liability. You have to have workman's comp insurance. To be an S, it just simply costs more. And to be an LLC, actually through your 1040, you get bigger benefits from those expenses as an LLC versus an S corp. One of the drawbacks of an LLC, if you are going to be particularly cash flow positive, is that it is possible that you would be taxed twice on some of your income. Because in that scenario, some of the income will be considered ordinary, then also some of it will be considered self-employment. And so there are situations where some of the income will be taxed twice. If you run into that scenario, then I recommend switching to an S corp, where you will only be taxed once. But as an S corp, you do have to run a payroll.
Do I need to pay quarterly estimated taxes? And is there a percentage or a certain amount that I should set aside?
Quarterly estimated taxes do not apply to a business. So if you're running an LLC or an S corp, there will never be any taxes actually due with a federal 1065 or a 1120S. However, as an individual, on your 1040, that's where the estimated taxes come into play. Again, if you have a large change in income from one year to the next, or you are cash flow positive running an individual business through a Schedule C, then I would recommend paying quarterly taxes. The safest calculation would be whatever your tax liability is in 24, to pay quarterly tax payments equal to 110% of the prior year taxes. And if you pay 110% of the prior year, you will not be penalized for anything. And if you overpay, you will get the whole amount that you overpaid back.
How should I separate personal and business finances?
If you are running a company and of course you have business or personal activity, you should have separate bank accounts for each. You should not commingle business activity in an individual account, and you shouldn't commingle personal activity in a business account. You should keep those separate. One of the most important reasons to do that is because if one of your returns is pulled for audit, if you're running a business and you're filing a business return, the first thing the IRS is going to ask for is bank statements. If you send them personal bank statements with business transactions included in that personal statement, that automatically opens you up to an individual audit as well. So if you are commingling activity in a bank account, whatever activity is in that bank account is eligible to be audited. So you should just, as long as you are running separate bank accounts, keeping separate sets of books, then that would be the way to go to protect yourself.
What records do I need to keep, and for how long?
The most important records to keep are bank statements and any general ledger activity and your tax returns. You should keep the records for a minimum of 3 years. I recommend keeping them for 5 years, and you should keep your tax returns for 7 years. You are only eligible to be audited or amend the prior 3 years, but a lot of times if you are in an audit situation, the IRS is going to ask for prior year tax returns, not necessarily the activity, but the tax returns, to verify some of the information that flows from year to year.
Are there tax credits or incentives available for my type of business, and how would I know?
The short answer is there's not really a lot of individual tax credits for small businesses at this time. Do I think that will change under the current regime? Yes, I do. But at this time, there's not a lot of small business credits available at the federal level.
How can I plan ahead to reduce next year's tax burden?
To reduce a future year tax burden, again, if you're going to have a large increase in revenue, but you see that you need to make a new capital asset purchase, be it a new car or a renovation to a building or some type of capitalized improvement, you should make the improvement in that year, even if it's in December. Because with the new rules, you can make a capitalized improvement in December and you still get 100% bonus depreciation as long as you do it before 12/31. You will get the full benefit of the expense in that year. So if you have a large increase in revenue or income and you can make a capitalized improvement in that year, you should do it.
Thanks so much for joining us for another episode of Did You Know? Be well.